Good day, everyone. Today, we'll explore an essential function of financial institutions: treasury operations. This department is the financial engine that powers the bank's liquidity, manages risks, and ensures compliance with regulations. Let's break it down in a way that's easy to understand. So, what is treasury operations? Treasury operations are a really important part of how banks work. Treasury operations involve managing a bank's funds to ensure its liquidity, profitability, and stability. Liquidity ensures the bank can meet its short term obligations, like customer withdrawals or loan disbursements. At the same time, the Treasury seeks to maximize profits by investing surplus funds strategically. It might sound complicated, but think of it like this: the Treasury is like a super smart pig bank that knows how to save, spend, and even make more money while keeping everything safe. So, let's dive in. The Treasury performs several critical roles. First one is cash management, monitoring inflows and outflows to ensure the institution meets its daily cash needs. Think of this like a jar of coins you use for snacks. You make sure there's always enough to pay for something right away. Second one is risk management, protecting the bank from market risks like currency fluctuations or interest rate changes. Imagine your friend wants to borrow a toy. You'd want to know they'll give it back safely, right? So, Treasury does the same. It makes sure that money isn't lost in risky deals. Third one, we have asset liability management, or ALM, aligning the maturity profiles of the bank's assets and liabilities to avoid mismatches. If you lend your friend a toy for a week, but you need it back tomorrow, that's a problem. Treasury makes sure what the bank owes and what it owns match up perfectly. For the last one, we have compliance and reporting, ensuring adherence to central bank regulations and preparing detailed financial reports. It's like keeping a diary of everything you spent and saved, so your parents know you're using your allowance responsibly. So we have here tools and instruments used. Treasury operations rely on various tools and instruments. Government securities like treasury bills and bonds, used for safe investments, foreign exchange transactions to manage international cash flows and currency risks, derivatives like swaps and futures to hedge against interest rate or currency risk. Each instrument serves a specific purpose in achieving financial stability and profitability. You might ask, how do treasury operations manage risks? So, risk management is at the heart of treasury operations. So we have here are three ways treasury operations manage risk. First one we have is market risk, managing exposure to interest rate or currency changes. If your favorite snack becomes expensive, let's say, you need to decide if you'll still buy it or save your money. Treasury does this with things like interest rates or currency changes. Second one we have is liquidity risk, maintaining enough cash or liquid assets to meet immediate needs. It's like making sure you always have coins in your jar for an emergency, let's say a snack. Third one, we have operational risk, mitigating risk from errors, fraud, or system failures. By constantly monitoring this risk, the Treasury ensures the bank operates efficiently under any market condition. So, let's think of it as this. What if your piggy bank breaks? The one where you store all your money and coins on. So basically, Treasury prevents things like errors or accidents in the bank. Why are Treasury operations so important? Without Treasury operations, banks would struggle to maintain financial health and customer trust. This function ensures that funds are available when needed, risks are minimized, and investments yield optimal returns. It's not just about numbers, it's about sustaining the backbone of the financial system. It's just like a kid spending all their allowance on their first day. It would run out of money and get into trouble. But Treasury keeps everything running smoothly. So, the bank has enough to spend, to save, to share, even when things get tough. In summary, Treasury operations are critical for maintaining liquidity, managing risk, and ensuring a bank's profitability and stability. As I kept saying, it's just like a smart piggy bank that minimizes its risk and everything. So, thank you for your attention, and I look forward to your questions.